If you have ever read a book or taken a course about technical analysis, you've probably come across candlestick patterns, support and resistance, trend lines, chart patterns, Fibonacci retracement, different strategies with indicators, and much more. You generally have to spend hours and hours trying to remember things like, oh, this is a bullish pennant, so I have to open a long position, or this is a bearish engulfing pattern, so I have to open a short position. Consider that there are thousands of patterns and all of this can be overwhelming, and frankly I've never been a fan of trying to remember things without really understanding them. In my years of experience as a trader and teaching trading, I realized that you can understand 90% of the tools used in technical analysis simply by learning three fundamental concepts. These three concepts are market structure, rejection, and breakout. Let's consider an example outside of the world of trading. You go to the supermarket to buy a drink, let's say a Red Bull. The price is $1, you buy it, you go back home and you drink your Red Bull. The next day, you go to the supermarket and there is an offer. This time, the price of the Red Bull is 75 cents. You buy 10 of them because you think that the price is quite convenient. The next week, you go back to the supermarket and the price is back to $1. Another day passes and the Red Bull is back to its sale price of 75 cents. This lasts for just one day, then the price goes back to $1. We can identify the so-called market structure. The market structure refers to the overall arrangement of price levels, trends, and patterns that emerge from a price chart. In this example, the market structure is given by the price repeatedly moving between the two key levels, which are $0.75 and $1. So every time the price drops to 75 cents, it doesn't go any lower than that, and after a while it starts to increase again, going back to $1. After it goes back to $1, it doesn't go any higher than that, and after a while it drops back to 75 cents. The price approaching a key level and then changing direction is called a rejection. The term rejection in trading refers to a situation where the market fails to sustain its previous movement on a specific price level and reverses its direction. In this case, the price drops to 75 cents and then it is rejected, meaning that the market fails to sustain the down movement, but it stops at 75 cents and then reverses. Then we have the same situation with the price going to $1 and then gets rejected, meaning that the market fails to sustain the up movement, the price stops at $1 and then reverses, so it changes direction. Rejections often occur at key levels. In this case, we have two key levels, one at 75 cents and another one at $1. Now, let's say that inflation is increasing, the owner of the supermarket decides to increase the prices, and the price of the Red Bull skyrockets to $1.25. In this case, the price has broken out of its previous range between 75 cents and $1. This is called a breakout. A breakout occurs when the price moves beyond the previously established key level or market structure. So at the beginning, we had the price having a series of rejections between 75 cents and $1 with a clear market structure of the price moving in a range. Then we have a breakout, with the price breaking through the previous market structure and going all the way up to $1.25. If you could trade the price of the Red Bull, how would you take advantage of this market structure? After you notice that the price is bouncing between 75 cents and $1, you could open long positions at the bottom when the price is at 75 cents and close your long positions at $1. Take your profits and open short positions there. You can do that several times and make money until you probably lose your last position when you try to do the same, and instead of having a rejection, we have a breakout. After you notice that the market structure broke and the price is going up, you can also open a long position on the breakout and make money here as well. Let's see some examples of Forex charts and see how I would attempt to make money with them. First of all, I want to try to understand the market structure. It seems that overall the price is going down, and there is a key level that seems to represent very well this down movement. Most of the times the price approaches this key level, then there is a rejection and the price goes back down. At the end, the market structure is broken by a strong movement of the price going up. How would I take advantage of a situation like this? After identifying the market structure, I want to open short positions when the price approaches the key level at the top. At the end, there is a breakout and it might be a good opportunity to open a long position and take advantage of the break of the market structure. In this example, it seems that the price is going up, but it struggles to overcome a certain level at the top. I would identify the market structure with two key levels, one at the bottom showing how the price is increasing, and one at the top showing how the price struggles to break through this sort of ceiling. At the end, the structure is broken with the price going down below the key level we identified. So how to take advantage of this? We could open long positions at the bottom of the market structure and short positions at the top of it. After the breakout, we could take advantage of the price going down to open a short position. So imagine if you were able to correctly identify the market structure in every situation and understand when you have a high probability of making money using the concept of rejection and when you have a high probability of making money using the concept of breakout. You will be an amazing trader and a very successful one. The tools of technical analysis that we're going to introduce in the following lectures will help you with these three concepts. They will help you correctly identify the market structure and understand when to place a trade using the concept of rejection and when to place a trade using the concept of breakout.